should you be trying to buy a house now if you're in the lucky enough position? What should you be doing with your superannuation? Maybe there's an inheritance you're wondering what you should do with. We've got all the answers coming up. Joining me is Chris Richardson from Deloitte Access Economics and Stephen Koukoulas from MD Market Economics. I feel like we should probably start, gents, and say disclaimer, not official financial advice. I'm sure there's an official one out there I should have mentioned. But anyway, be wary. Having said all of that, two pretty good economic minds here and people that watch things very closely. Short and medium-term prediction, first of all. I'll go to you, Chris Richardson, on Australia's stock market, so the ASX, and perhaps what might be the big impact on that?
I think the big impact is coming from the biggest story in economics in 2019. It's not trade wars, it's the fall in interest rates you're seeing all around the world. It's more notable in terms of long-term interest rates in Australia than pretty much anywhere else in the world. Other things equal, that says all sorts of markets, prospects are better than they'd otherwise be. Share market is a reasonable prospect off the base of that. Other things equal, it's probably the better buy among available markets in Australia at the moment. So
in terms of where do you think it's going to track? Because we've seen it edge up towards this figure we got to pre-GFC. Do you expect it to finally crack on through in the sort of short term, up to 7,000?
My expectation is that it will continue to rise unless and until the bad thing happens. The world has become a rather more dangerous place in the last handful of months. Not just, again, trade wars or Brexit and so on, or indeed Hong Kong. You're seeing the push and shove between Iran and the Saudis. You're seeing India and Pakistan. But absent that type of bad thing happening, yes, markets continuing to push to new highs.
All right, so a new high with an asterisk, perhaps. What about your thoughts, Stephen Koukoulas?
Oh, look, I think Chris is right. I think there's going to be some real strength in the stock market. We've got this low interest rate environment, so alternatives such as government bonds, term deposits are yielding a very poor yield at the moment, to be frank. So people who are happy to take on a little bit more risk to get a slightly higher return are certainly going to allocate some money to the stock market. And I think it's interesting, since the interest rate markets have rallied so hard over the last year or so, the stock market has tested these record highs here on the ASX.
Tested and sort of retreated though, hasn't it?
Yeah, haven't quite made it. The thing to remember there too is that, of course, the mining sector has a very big weight in our index. Of course, we've got this iron ore price very elevated at the moment, as we heard last week from Mr. Frydenberg with his budget update, that if we do get a correction in the iron ore price back to where the budget assumption was, which was $55 a tonne, currently around 90 today, then of course the big iron ore producers will fall. That'll drag the index lower, but basically a low interest rate environment with the economy muddling along, no real inflation pressures or risks, it should do well.
So, when people are reading a lot of these headlines at the moment, all the potential dangers Chris was talking about, I guess there's a temptation, and it's easier to jump into a lot of super accounts these days and change your investment option. If someone's tempted to go defensive right now, you think that might not be the best mindset?
I wouldn't say no, because the bond market's rallied so hard, and it doesn't mean that it can't rally further. Gosh, who would have thought we would have seen negative yields in government bonds in Germany, for example? The 10-year yield there's minus 0.5%. So the bonds can still do well from an investment perspective, but in terms of a running yield, in terms of an asset allocation decision, probably you need your safety in some of those very defensive, very cautious investment allocations. But when the global economy is still growing, notwithstanding some of these geopolitical risks, some of the other central bank policy risks. We're just not sure what's happening with the ECB and big central banks like that. The Fed's under pressure from the US president to keep cutting. There are risks there, but you would have to say the risk reward is probably being invested into the stock market, because it probably will trend higher.
What's the point, though? Because I guess a lot of people figure that, things could turn sour. Here's what I'm watching. Where's the point you'd pick to say, oh, no, the good ride is over? Because some people were saying December last year there were enough warning bells and they might have pulled money out of investments. What would you be watching for, the trigger point?
Well, I've mentioned some of those potential flashpoints. And again, those risks have risen around the world. Mind you, I think Steve's phrase of muddling through, I think that's true internationally. I think that's true in Australia. It is so far so good. On that choice of what you do with your money, don't forget it's not just what's happening out there in the world and markets, it's also how brave or not brave are you as an investor? Sometimes that's related
What point
to
of
how
life you
old
are
you
as
are.
well. Yeah, 25 versus 65 in super, for example. Very different approaches. Yeah,
and look, big picture, markets have gone up magnificently in value broadly around the world. Interest rates peaked a third of a century ago, and it unleashed magnificent capital gains as they came down.
Yeah.
There are some people who've got the full ride out of that.
Because that goes back to there were a lot of doomsday scenarios in December, and if you had made the decision then, you'd missed out on what, 20-something% growth, depending on where you were at.
Big bucks. And again, the key is, between them, markets and central banks have decided broadly to push money back towards being the cheapest that it's ever been in recorded economic history. Certainly that's true with longer-term loans.
Now, you mentioned interest rates. I know this is something you keep a close eye on. So it feels like we're going to 0.5%. And then what? I mean, when will the next rise possibly be?
So
when can the economy take an increase?
Don't even worry about that yet. We've got to get through this easing cycle.
Yeah.
So the cards are aligned for a move next week from the bank. They're going to be probably trimming rates to 0.75%. And probably another one after that. The inflation rate's so low, as we saw last week with the labour force numbers. Even though the jobs numbers are great, we've got this surge in population, surge in participation rate, particularly amongst older workers. And that's keeping a degree of slack in the labour market. The unemployment rate at 5.3, not horribly bad, but well above what would be considered full employment. And the underemployment rate's creeping up as well. So we've got this dynamic, I suppose, that in a sense it's not surprising given the GDP numbers showed annual growth at 1.4%, so well below trend. You'd expect the unemployment rate to weaken. So the RBA's got to cut first. The rate hikes, gosh, they're so far into the future that I'm not quite sure what will happen before then.
Is it fair enough to say nobody, every, I think, mortgage broker would say this anyway, but don't fix your rate? All these temptations now of lock in this sort of rate, you never know when it'll go back up.
At some stage, rates will go back up in Australia and around the world, but that does, appear to be relatively distant. A big thing that most people don't get, true in Australia, true around the world, interest rates are being cut at the moment by central banks like our Reserve Bank for two reasons. One is, and again, Steve was noting, the economy is a little softer. Here in Australia, around the world, the economy is softer. But the other thing is a structural change. Economies work differently. It takes, these days, a lower unemployment rate in order to get wages moving and prices moving and so on. It is that other calculation being made by many central banks.
And of course, that ties in as well, I guess, to inflation, which we almost seem to have this new norm of inflation. And I guess there are going to be more questions asked at some stage about whether or not the target we've had for a long time is still fit for purpose.
And I would say it is, but we do need, fast or slow, in Australia and around the world to get unemployment lower. Australia's position, and Steve's noted unemployment's creeping up here. Globally, though, unemployment's about as low as it's ever been. In the US, it's at a 50-year low. In the UK, it's at a 45-year low. The Eurozone, it's down to a 12-year low.
And yet a lot of these economies still have their problems.
Right, because that trade-off has changed. It's a challenge.
Housing market, I know you love prognosticating in this area. I forget what mountain you were going to... Was it Kosciuszko?
No, it was Professor Keane who climbed that one.
Right.
I don't think I'm climbing any mountains at the moment.
But you threaten to every now and then.
Oh, every now and then. Look, I think the cards have aligned for a house price recovery. Again, not boom conditions, but if you think about the price falls that we saw, particularly in Sydney and Melbourne, they're actually still falling in places like Perth, Adelaide and Brisbane are a bit softer now. So if you think about the big cities, if you like, there's been a slight change in the dynamics. But if you think about what's happened, prices fell in Sydney, Melbourne. So incomes rose, albeit moderately, and we've had these interest rate reductions, both from the central bank, and the mortgage market's pretty competitive. And it's easier to get credit now than it was perhaps 12 or 18 months ago. So in a sense, if you think about what drives housing markets, house prices, it is supply and demand, it is the level of prices, it is wages and it is interest rates, and most of those are either slightly positive or very positive.
So, because there's still articles out there talking about perhaps the overvalued of the Australian market and so on. Are you willing to say, I don't know what time frame we give it, end of next year, that from now to then we're going to see
I'd say,
steady increase?
Yeah, steady increases. My hunch would be somewhere in the order of between 5 and 10%. Depends on the city, of course, but as a nationwide rate, capital cities price index.
Nationwide 5 to 10?
5 to 10% by the end of next year.
Right.
Yes, I think so. Because of these dynamics. The fact that the labour market, even though it's a little softer, as Chris was touching on, it's not bad. Loan default rates from the banks. We've had a couple of the big banks just reporting in the last few weeks. They confirmed that loan arrears and bad debts are still very low. So even though we're not getting big wage increases and the labour market is deteriorating a little bit, we're still making our mortgage repayments, which is a very bullish sign for house prices.
And Chris, you gave some advice of sorts in this very area in 2017. So judging by that, people should be tuning in right now as to whether or not they're going to buy a house or sell or whatever it might be, because remind me, I think in April 2017 you were saying don't get into the market, rent instead, and just after we saw the peak of the market, and in Melbourne and Sydney a pretty steady drop after that. So people avoided the worst if they listened to you.
If only, Tom.
So what should they do now?
And I absolutely agree with Steve. In the next little while, housing prices are headed up. When they were falling, we had a phase from late October for a number of months where in Sydney and Melbourne, the average house was losing $2,000 a week in value. Last month, they were already back to rising at $1,500 a week. Yeah, right. Last week, you saw the average house in Sydney, the value go up $4,000, and in Melbourne, $3,000. It's bouncing, but those prices, they're still too high. They're bouncing because they're getting lots of singing sauce, in particular out of interest rates. Of all those factors that Steve listed, the main one is interest rates, and that story is good. I still think housing prices are overvalued, but that's not going to stop them going on their merry way in the next...
All right, final question. You're coming into inheritance as we speak, and you have to do something with all of it. Shares, property, or in the bank for the next 2 years?
Reduce your debt, even though interest rates are low. But look, I'm more of a fan of the stock market.
Stock market?
Yep. Stock market for me, I think there's growth to be had there. You'll get decent returns, high dividend, and depending on your age, again, if you can get the fully franked, the franking credits, you're having a double dip.
Chris Richardson?
Stock market would be the key, but keep some in cash. It is a dangerous world out there.
All right, well, we'll note a few of the bits of advice there, because you certainly got it very right last time. Chris Richardson, you've got a pretty good record as well, Stephen Koukoulas, but appreciate the discussion. Thank you.
Thank you.